So let's go inside out now on FedEx ahead of that earnings report. Joining us now is Don Nesbitt, Senior Portfolio Manager, FM Investments. Thanks so much for joining us, Don. What are your expectations for FedEx and this report card?
Hi, Sam, and thanks for having me. Yeah, expectations, not kind of a mediocre performance, as you said, coming in around $3.65. The interesting thing will be, what they talk about along with those earnings, where they see traffic going, how the consumer is holding up, as we've seen. It seems like we're getting some pretty good reports on the economy and the consumer. So we'll see how they do and what kind of guidance, if they give that. Now, that was the thing at last earnings. They actually beat last quarter, but the stock was punished because they couldn't give any guidance for the 2026 year. So we'll see if that continues to be the case. They're reluctant. And this has been a theme that's gone through the whole earnings seasons. Are those companies who are reluctant to give guidance are punished? Those who can address, especially the tariff situation, and give guidance, positive guidance, have been rewarded. So it'll be interesting to see what they talk about along with these earnings.
Yeah, it's been certainly interesting. Those who sort of pulled guidance the previous quarter, I mean, for the most part, we've seen quite a lot of companies reinstating this quarter. So let's see. I mean, this is such an important company as to a barometer, as you say, of the health of the consumer, global shipping trends, also business, how some of the small to medium enterprises are feeling right now. I mean, what should we be paying attention to the most, do you think, Don?
Well, the interesting thing about FedEx is they've just they're wrapping up their drive program, which is basically a consolidation of their different divisions, and promoting some more efficiencies, operational, working with data, so forth. And also they're kind of kicking into a network 2.0, which will continue to improve. The idea is that they are improving cutting costs, improving operational efficiency. But again, they were punished for that because of their overall guidance regarding tariffs and the uncertainty there. But I would present to you that who knows what's going on with tariffs. So I think this company is very well positioned once we get through this whole tariff situation and back to more normality in terms of the economy, trading, and so forth, to really benefit from that.
Yeah, I mean, just within the whole tariffs policy, very quickly, if I can get your thoughts on the, expiration of the de minimis exemption. I mean, how big of a sort of impact is that going to have on FedEx, given some of the commentary we've heard out from the others in this space?
Yeah, that is kind of the wild card here, to see how that's going to affect and work down, since that de minimis trade is basically packages of $800 or less, and went into effect at the end of the August. So we might not see the effects in this quarter's earnings, but we'll see how it does in the next.
Yeah, you raise an interesting point about that timing as well. Perhaps this is not the quarter to see evidence of that. Don, we're going to have to leave it there. Thank you so much for your time. Short and sweet today. Don Nesbitt, the Senior Portfolio Manager, FM Investments. Appreciate it. Well, let's trade it now with Tom White, host of Fast Market. So you've got two FedEx example trades here. First one is bullish and the other is bearish. Walk us through those, Tom. Good morning.
Yeah, thanks, Sam. I kind of looked at this, two different strategies here, but at the same time, still using a dispersion between implied volatility levels going into this report. So we'll lead off here with a bullish trade, and this is a bullish call diagonal, a short-term trade here. I went out to the October 3rd weekly cycle here, so you've got 15 days in your long option. We're going to buy the at-the-money 227.5 strike call out in the October 3rd weekly cycle. And then in the near term, sell the September 19th, the monthly options. We're going to sell the 245 strike call. So if you look at the setup of this, you've basically got about a $17.50 wide bullish call diagonal. The option market's priced in about a plus or minus $17 move in the shares. So this aligns with what the option market's kind of pricing in. This is a bullish trade, though. You're going to pay roughly about a $740 debit for this. That's going to be your risk, $740 per spread that you put on. And anything above about the 231 level is going to be potential profitability. Now, as I mentioned, this is a $17.50 wide bullish call, a diagonal, but you're only paying $7.40, so less than half the width of it because the implied volatility levels. You're buying about a 55% implied volatility in the October 3rd weekly options, selling about 150% implied volatility in the near-term option. So that dispersion lowers the entry point, but you definitely need to move to the upside. That break even about 231, 232 is about 1.5% above the current share price.
All right, good stuff. Thanks for getting us across that example trade on the bullish trade. What's your bearish one for this one, Tom?
Yeah, so it's the same setup. We're using that dispersion between implied volatility levels, but I looked at a different strategy using the same option series. So I looked at a put calendar here that'll give me some exposure to the downside, but lower my cost entry point on this position too because of those volatility levels. We went out to that same October 3rd weekly options that expires in 15 days. We're going to buy the out-of-the-money 210 put. That aligns with about that one standard deviation that the option market's pricing in at this point to the downside. So you buy the 210 put in the October 3rd weekly cycle, sell that same 210 put in the near-term September 19th monthly options that expire in just one day. You're going to pay roughly about $1.30 debit for this 2-week wide put calendar to the downside. That's going to be your risk, only $130 per spread. But you can see here from the risk profile, you want it to go at or near 210, but at the same time, you've got a range probably between about 195 and maybe 225 that you can still be profitable on this type of trade. But it takes advantage of that vol dispersion, low cost and risk entry point to a bullish example trade or bearish example trade here, Sam.
Okay, looking at a bullish and bearish example for FedEx ahead of its all-important earnings this afternoon. Thank you so much for that, Tom White. Appreciate it as always.